Hi, today we are going to talk about Statute of Limitations, or SOLs, as well as filing deadlines, interest and penalties, as well as my favorite discussion, whistleblower rules. Here we're going to talk about all the just kind of the nitty-gritty of what it means to file your taxes. So let's get started. All right, so to start off with, what are SOLs? They're statutes of limitation. Essentially what this means is, what is the very last date that a taxpayer can file an amended return, or the IRS can challenge that return. So for statutes of limitations, there are 3 rules. Remember this: 3, 6, 0. You have 3 years from the ladder of the date that the return was actually filed or the original date of the tax return. The next is 6 years. If the taxpayer substantially underestimated their income, they have 6 years to be able to come back and look at your return, or you have the ability to amend your return. So what does it mean to substantially underestimate? That means that a taxpayer omitted gross income of 25% of the income stated on the return. Then you have no time limit if there is fraud or there's a failure to file. So pro tip: in the event that you are audited, to make it as easy on you as possible, you must be able to prove that you filed your return. And in order to do that, you need to have proof. So therefore, you should keep your tax returns forever. Now, a lot of people keep the documentation associated with that. You only need to include the documentation in your records for 6 years. After 6 years, get rid of that stuff. You only need to make sure that you can show that you filed your tax return. Second off, you need to prove that you actually did file your tax return, and that's in the form of either a return receipt request if you filed your tax return paper style, or the proof that you filed it electronically. Okay, so now that we've talked about statute of limitations, when did you actually file? What are the rules regarding filing deadlines? The first thing that we need to talk about is year ends. So depending on when you file, it actually depends on when your year end is. Now, this means what is the time period in which the IRS is able to look at your income, your deductions, etc. And so most people are on a calendar year end. That means all information from January to December 31st is included in your tax return. But you can also elect to have a fiscal year end, or any other year end that you want. So you want to have your year end after the holidays so that you can include all of that income, then have a March 30th year end. There are a bunch of different fiscal year ends depending on some rules, and we'll talk about that at another time. So when do you have to file? As individuals, you have to file on the 15th day of the 4th month. So that's why April 15th is such a big day for most individuals, because that's the day, the 15th day of the 4th month of their calendar year end, unless they elected to have a fiscal year end. Now, this 15th day of the 4th month also applies to partnerships. For corporations, it's the 15th day of the 3rd month, or March 15th. Or if you choose a fiscal year end, then it's the 15th day of the 3rd month after your fiscal year end. And this also applies to S corporations. Now, you can extend the deadline for when you have to file your tax return, and that's called an extension. It's an automatic 6-month extension, but you must file this extension request by your typical year-end deadline, the 15th day of the 4th month or the 15th day of the 3rd month. And then you get an additional 6 months. That's why for most tax preparers, they have 2 tax seasons. The first is January through April 15th, and the next is typically August through October 15th. So let's go through a problem. As an individual, you decide and you do file on April 1st. You don't make an election for a fiscal year end. Why is this important? Well, that's because the IRS has until 3 years from April 15th to be able to look into your tax return or for you to be able to amend, to correct anything, or to add something. Why isn't it April 15th? That's because the first date that they can start the statute of limitations is on April 15th. Not before that. That's the drop dead deadline. Now, if you extend your return, the date is the date on which you actually file. So let's try another problem. You're an individual, you file an extension on April 15th, you then file your completed tax return on September 10th. When is the last date which a statute of limitations 3 years from now you can either amend or the IRS can audit you? You're deemed to have filed on September 10th, not October 15th for the statute of limitations. So now let's talk about interest and penalties. These are great. So for failure to file, there is a 5% tax due for each month or partial month that the return is late, not to exceed 25%. The failure to pay penalty is 0.5% per month or partial month, up to a maximum of 25%. Now, if there is both failure to file and failure to pay penalties, the failure to file penalty is reduced by the amount of the failure to pay penalty. Now, negligence. Negligence is a little bit more intense. There is a 20% penalty if the underpayment was for intentional disregard of rules and regulations. There's no intent to defraud, it's just an intentional disregard. There's a difference here. The penalty applies to the portion attributable to the negligence. So, a problem. Let's say Craig underpaid his taxes in the amount of $30,000. Only 15% of the underpayment is attributable to negligence. Craig must pay a negligence penalty of $3,000. That is 20% of $15,000, which is attributable to the negligence. This would be in addition to the failure to pay penalty. Now, fraud. Fraud penalties include various different types of penalties. We're just going to go through an overview here. Fraud requires specific intent to evade tax. Civil fraud is a penalty of 75% of the underpayment attributable to the fraud. However, criminal fraud can include large fines as well as prison time. Criminal fraud is a willfulness on the part of the taxpayer, not just an intent to evade, but willfully trying to get out of it. Now, if there is a fraudulent penalty, there is no negligent penalty, and if there's a negligence penalty, there is no fraudulent penalty. For tax preparers who are involved in preparing these tax returns, there are statutory penalties imposed on you. So therefore, you got to look at the ethics behind this. Do not take questionable positions. Only use reasonable estimates. If it's not a reasonable estimate, do not put it on the tax return because you will be responsible because you knew better. Make every effort to answer the questions on the tax return and provide information that is necessary. And then advise to make corrections on tax returns that were filed in the past. You don't have to inform the IRS that there has been some sort of a issue or an error in a past return, but you do need to inform your client that they should amend their return to make a correction with those returns. If they won't make a correction, withdraw. You do not want a bad client. It's not worth it. All right, and now for my favorite part of this episode. We're talking about whistleblowers. Now, what is this? The IRS can reward people who provide information that leads to the detection and punishment of those who violate the tax laws. So in 2006, the program for whistleblowing was revamped to provide higher rewards and more incentives to collect the estimated $100 billion of unpaid taxes per year. So what is this reward? It's up to 30% of the taxes, fees, fines, and penalties that are recovered. So my favorite story, Bradley C. Birkenfield. He was a former employee of UBS Bank, and he was able to provide information on a conspiracy to help wealthy California developers evade U.S. taxes. The information that he provided was so helpful that the IRS was able to cover $5 billion in unpaid taxes. And so the IRS gave him $104 million in Whistleblower Awards for revealing the secrets of the Swiss banking institution. The problem was that Mr. Birkenfield was a part of this conspiracy. He was actually helping these California investors and developers to evade taxes. As a part of the investigation that the IRS conducted, Mr. Birkenfield was also implicated, and he served 2.5 years in prison. 2.5 years of prison for $104 million? I've never served prison time, but that seems pretty good to me. And that's what happens with a lot of whistleblowers. They're actually involved in it, and then they end up serving time for their involvement, even though they're trying to do a whistleblower of their employer or of the organization that they're a part of. So anyways, hope this information was helpful. If you liked it, please give it a thumbs up and subscribe. If you have any questions, please leave a comment below, or feel free to email me at centerfortaxstudies@gmail.com, and we'll see you next time.